what I'm now going to do is bring in our special guest for this week, Richard Aston, to talk about CC Japan Income and Growth and their sort of Japanese income strategy. You can see on the screen, we just got a little bit of blurb about Richard. He has sort of more than 20 years experience in managing Japanese equities. He doesn't just manage the CC Japan Income and Growth Trust, he also runs the CC Japan Income Growth Fund, which is an Irish UCITS fund. Richard began his career as an investment analyst with Sun Life Asset Management and was appointed as portfolio manager on the Japanese desk in '97. In 2000, he was appointed head of Japanese equities at Chase Asset Management in London, and then obviously became part of the JP Morgan sort of Japanese asset management team following the merger with JPM. Richard joined Cooper & Cardiff in 2010, where he's been running their Japanese strategies ever since. Hi, Richard.
Hi, Matthew. Thanks very much.
Just flick forward to your slide. So, would you be kind enough just to give us, sort of 5-minute introduction to the fund for those that perhaps haven't come across it before?
Yes, great. Thank you very much for the opportunity to do that. Yeah, around about 2010, 2011, when I moved back from Japan, we felt we had the opportunity to launch an investment strategy for Japan or for Japanese equities that was much more relevant for the way that the market had evolved, the way the economy had evolved, and for the valuations that we were seeing at the time, rather than many of the strategies that we felt were much more prevalent at the time, that were focused on either deep value or growth, or extreme levels of growth, which had been much more relevant in prior years in Japan. It's really a strategy we identified from the bottom-up analysis that we're undertaking individual companies and how they were allocating their cash flow, and in an increasing number of cases at the time, giving greater attention to their shareholders. So maybe if you just look at the first slide of the presentation, I think it shows really from a top-down level what it is we were beginning to see. The chart on the left-hand side is sort of aggregate cash flow from the corporate sector. That's the yellow line, and there is a blue line there, which is cash flow spent or CapEx. Mm-hmm. And there was this extended period, really through the economic miracle of the Japanese economy post-war through to the late 80s, where companies were spending everything that they generated, reinvesting all of that. That extended even through the lost decade of the 90s. And it wasn't until really after the Asian crisis and the tech crash at the beginning of this century that we feel Japan really finally began to address the problems that had been created by this period of overinvestment. And you can see that there's a very notable change there because the two lines diverge. Mm-hmm. And that was very much reflective of a change of corporate management, a response to some of the challenges that were now being faced by companies. So at that time, around about 98 to 2000, we saw nationalization of the banking sector. We saw bankruptcies of quite a number of major of leading companies in industries that were almost unheard of, life assurance, construction, securities, etc. And as a result of that, sort of corporate mindset changed. And the use of that cash flow was very, very interesting because first and foremost, companies were required to pay down all of the impaired assets that had been accumulated in the years before. Companies started to pay down levels of excess debt, and that process has really continued even to today. Japanese companies, or many of them, have been deleveraging consistently. Mm-hmm. Now for a long period of time. But also you can see, if you look at the chart on the right hand side, a portion of that now surplus cash flow started to come back to shareholders in the form of dividends and share buybacks in a way that it hadn't done before. That is of what was of particular interest to us, something that we noted. However, if we go back to sort of pre-Lehman crisis, the valuation of Japanese equities always appeared to be at a premium to global markets. And it wasn't until that period of 2010 onwards that we were able, for the first time, I think, to say that Japan had finally lost its premium, finally derated from the bubble valuations. Yeah. And was offering some interesting valuations because for the first time in my investment career, I was able to find companies listed in Japan who had valuations that were comparable, if not cheaper, to the international peer group. We launched the strategy at the beginning of 2013, and that was very fortuitous because former Prime Minister Abe announced a very major restructuring or a number of initiatives really to reignite the Japanese economy shortly after that. And in the third arrow, there was a very definite emphasis on the corporate sector and how they were to improve capital efficiency, improve their corporate governance. And a consequence of that, I think, has been this steady improvement in shareholder return. And that's really the focus of this strategy, total shareholder return, of which dividends are an increasing component.
Excellent. I mean, between the sort of two, I mean, how much do you think comes from sort of income, and how much would you expect from sort of capital growth over the long term?
And that's a good question. I mean, we have a chart that is showing actually the contribution from dividends is increasing. Obviously, that's been boosted, I suppose, by general weakness in equity markets over the last year. But we do see there are certain characteristics in Japan, maybe as an economy, certainly in terms of the equity market, that are very similar to the UK. And if you look at the UK, the contribution from dividends is very, very significant, and we expect Japan to continue to move in that direction.
Yeah. I mean, how easy is it to find income in Japan? You don't think of it as sort of being a high yield market, as you point out.
Yeah, I think, I think if you look back historically, that's been entirely the right view to have. Companies have not really paid attention to their shareholders in the way that investors in other markets are more familiar. But really, things are changing, and we are finding an increasing number of companies that are willing to reward their shareholders on a consistent basis. And the particular attraction, I think, of Japan is that there are an increasing number of companies really that are in that very, very strong position. So one of the attributes that we see of Japan as a whole, and certainly to individual companies, is very, very healthy balance sheets. That's a consequence maybe of the historical track record that I've mentioned, companies paying down debts now for over 20 years in aggregate. And also the fact that up until maybe sort of 10 years ago, there wasn't really a shareholder focus and understanding of the requirements of shareholders. So many companies were just accumulating assets on their balance sheets, liquid assets, and now those are flowing back to shareholders. So finding companies with attractive yields is becoming easier as time goes on, because the strength, the financial strength of the companies is very evident. And we're finding more and more companies whose management are sort of willing to accept the role of shareholders.
I suppose in that regard, obviously there's been big changes in sort of recent years to the corporate governance code in Japan, which has obviously praised or put much more emphasis on shareholder returns. I mean, do you think that's made a big difference to your universe?
It has, definitely, yes. I mean, that was one of the initiatives that was brought under the Abenomics umbrella. Improvement in stewardship code initially, so that's the forcing a relationship with sort of domestic pension funds and domestic asset managers with companies, requiring them really to ask the sort of questions that I think international investors ask companies. And then that was followed by the corporate governance code, which has created this new environment. The combination of the two, really, the stewardship code and the corporate governance code, have created this new environment in which shareholders and corporate management can communicate in a way that they weren't before.
Okay, that makes sense. And we've got a question from the audience here. It says, how are company valuations in Japan looking today compared to other markets? I mean, is there sort of still a problem whereby you can sort of look at Japanese equities and you try and compare them with other markets, and they're distorted because of higher cash levels on the balance sheet? And if so, how do you take account of that?
Yeah, I mean, if you look at sort of headline valuations, I think Japan arguably looks cheap on some measures. Obviously, price to book is one that people look at, and that's a tangible book. Those are real assets on the whole. If we look at it in terms of earnings, I think Japan stands up very well, given the cyclical component of the earnings as well. Obviously, we're focused specifically Well, yeah, I mean, the main focus of our investment approach really is to focus on companies that have a very, very attractive sort of shareholder return valuation, and by that we take into account the return to shareholders through dividends and to some extent share buybacks, and also consider sort of the growth potential. And I think it's really sort of the combination of the the current yield that you're able to sort of generate off Japanese equities, combined with the growth prospects for that income, that really make it very, very attractive.
Yeah, okay. Just on the income, there's a couple of sort of questions here. Somebody's asking sort of what's the outlook for dividend growth? I mean, I presume it's probably sort of specifically for your portfolio, or sort of maybe for the market in general. I'm guessing that given the sort of backdrop of the current environment or market environment.
Yeah, I mean, I think the outlook is very good. And one of the reasons I say that is that even though the domestic economy has been somewhat sluggish, given relatively delayed removal of a lot of the sort of pandemic restrictions, actually the dividend growth has picked up very, very dramatically.
Mm-hmm.
Actually, you can see that to some extent from the chart that's still on the screen on the right-hand side. The blue bar are the aggregate distribution from the market. You can see how consistent that was from 2012, the growth, and how robust it was during 2020. Mm-hmm. The number of companies that cut dividends and the aggregate amount of dividend cuts have been relatively low in comparison to other markets, Europe and the UK in particular. And you can see the speed at which that's recovering. Yeah. If you look at companies after the first half of their fiscal year, dividend growth has been very, very healthy. Mm-hmm. If you look at the aggregate from that period, from 2012 to 2019, I think on average that was about 7.5% growth a year. We see no reason, certainly if you take on, consider that actually the number of companies with net cash and in a strong position to distribute dividends, mm-hmm. It has increased, then we expect there to be significantly stronger growth of dividends than other markets, which really is continuation of what we've seen over the last 10 years.
Okay. Another question here just relates to that. What's the yield on the underlying portfolio, sort of roughly?
The yield's currently at about 3.6%. That's based on the dividends received from the companies themselves.
Yeah. And sort of, did you find, you sort of mentioned COVID a moment ago, but did you sort of find that there was any, because I suppose in a sort of difficult market environment, it's easy to say, well, actually, we're going to focus less on returning these great swathes of cash that we have. I mean, the feeling that I got is that most companies actually didn't water that down. But so what was your experience?
That was absolutely right. Again, you can probably see that from the chart there on the right-hand side. What I haven't yet mentioned really is, I suppose, one of the most significant changes we've seen in attitudes towards shareholder returns over the last few years is an emphasis on the dividend, mm-hmm. over share buybacks. I think there's a lot of uncertainty, if I go back to the initial discussions, amongst the corporate management as to what would be the best way to reward shareholders. But I think we've seen very clearly over the last few years that dividend is their chosen way, and more and more over the last few years have emphasised stability of that dividend. And that was very evident during 2020. You can see there that the decline in dividends was quite small, and any sort of flexibility that they required came through in terms of share buybacks.
Okay, you might have just answered the next question actually. Somebody's asked, do you have to compromise on quality to find income in Japan?
No, I think that's the unique opportunity that there is at the moment actually in Japan, in that the quality of companies are very, very high. If you look at the portfolio of companies that we look at, there are some well-known international leaders, companies whose brand names are well established, and are recognised maybe by everyone. Others whose skill really is technology that puts them maybe behind consumer brands, but are very, very important in the construction of those mobile phones, etc. Mm-hmm. There are companies that are very strong regionally. So we understand that some people's views on Japan are tempered by knowledge of the demographic profile and the declining space. but actually a lot of the companies in Japan are benefiting, I suppose, or well positioned to benefit from their geographic location right on the doorstep of very rapidly growing economies and consumer bases, not just China, but places like Indonesia, Malaysia, etc.
Yeah.
And then finally, I mean, despite those concerns people might have about the domestic market, there are still opportunities for companies to grow, in particular niches or in particular areas. And these companies are very, very high quality, and that's an important component really of the decision-making process.
Yeah, I suppose just on that, we're talking about obviously the wider emerging Asia, etc. But it's obviously well placed to sort of benefit from the growth in those markets. That obviously has two sides to it. So with all of the sort of troubles, etc., that we're seeing in China, I assume that it's sort of quite a big trading partner for Japan. Is there sort of a material knock on to Japanese companies?
Yeah, you're absolutely right. I mean, China became Japan's largest trading partner about 7 or 8 years ago, right. And the relationship is very, very important, either as an end destination for products, or a manufacturing base for others, or even just part of the supply chain. So, what goes on in China is important for a lot of Japanese companies. What I would say is actually it's very clear over the last few years that companies in Japan have been sort of de-emphasizing, in many cases, China in preference to other markets. So, right. Firstly, if I think of it from a production base, with rising labour costs, maybe less confidence in energy supply, companies have been shifting production to other parts of Southeast Asia, like Vietnam or Myanmar. So it's important, and for some individual companies, it's very important. But for others, it is just part of a sort of global, global opportunity and risk where relevant.
So you sort of mentioned energy supplies, energy costs there. I mean, my understanding is that was always quite a fine balance within Japan. Obviously, you used to have a lot of nuclear because it didn't tend to have the hydrocarbons that sort of other nations had. But obviously, post Fukushima, they sort of shut a majority of their, I think they shut all of their sort of nuclear power plants. They've recently been switching one or sort of two back on. But how have they fared just in the sort of current market environment and the sort of rising cost of energy?
Yeah, it's certainly a challenge for Japan, which certainly imports the majority of its raw material needs, and that includes energy. Companies do address that individually, but from a national standpoint, there is greater emphasis on reducing the exposure or reducing the need to keep importing fossil fuels. Solar power has been an area where there's been a lot of investment, and now there is a lot more talk about restarting the nuclear facilities, as you say. I think about 9 have been restarted out of approximately 60. There is a plan recently announced by the Prime Minister to restart another 15 in a short time. And I suspect that actually nuclear power will be an important consideration going forward in Japan.
Right. So just, I guess, in terms of your portfolio companies, I'm guessing you're not particularly worried about energy costs in that case, sort of feeding into the bottom line. Is that a fair comment, or?
No, I mean, it is important. I mean, the government has introduced subsidies for a lot of small and mid-sized companies to help them offset that. Right. Larger companies are very adept, I would say, at managing their cost base, and have proven that many times in the past. They've operated in effectively a deflationary environment for quite a period of time, and have coped very well. So it is an important consideration. It is a greater risk, I suppose, to some companies more than others, but it's certainly a consideration that we have when we're looking to invest.
Okay, so change of sort of topic here. We've got a question from Tim, who's obviously sort of eagle-eyed on your subscription shares, and he says the current batch of subscription shares are due to expire soon. Are you likely to raise more capital from shareholders in the same way?
I'm not quite sure I'm the one to answer that question. In that,
perhaps one for the board, really.
Board. Yeah.
Yeah.
Yeah, I think that's probably the fair answer.
I mean, I've not looked recently. Have they sort of been successful thus far?
The subscription shares haven't been exercised. No.
Right.
Have, despite getting very, very close to exercise price on a number of occasions, have not exceeded it for at the point of exercise, which is once a quarter. The final date is the end of February next year. Obviously, the board in the long term, I know, are very intent on growing the size of the trust if possible, for the benefits that brings, both in terms of liquidity and also in terms of lowering the average costs. So it's important to them that they are seen to grow the trust as well, I think, in time.
Okay. We sort of touched on this previously, but sort of we've got a question here. What sort of structural trends do you feel offer good opportunities? And I guess we're sort of related to that. So what sectors look appealing? Are you focused on at the moment, and why? Obviously, we've touched on the fact that there's an aging population, but my understanding is there's a lot more sort of female participation in the workplace. And I'm guessing that's throwing up opportunities. I mean, what would you talk to that?
Yeah, absolutely. I mean, it's an interesting economy. It is facing some of the challenges that maybe other economies around the world are facing or will face going forward, and seeing how they cope is fascinating, really. In terms of the way we invest, we tend to invest with a long-term time horizon. The turnover in the portfolio tends to be quite low. We're looking for companies really that can benefit us through compounding, so companies that will continue to grow their dividends time, and we benefit from that. So rather than being purely thematic, however, having said that, we do quite often identify opportunities that lead us to some quite interesting sort of conclusions and themes. And at the moment, I would say that there is a very significant opportunity in Japanese equities, and that's purely to do with the sort of relative growth of economies. As we're seeing or are concerned about recession in other parts of the world, actually Japan, partly because it's been quite sluggish and slow in coming out of the pandemic, is set for, I think, accelerated growth in 2023. That is supported by free movement of people again, and potentially the benefits of the revenge demand that economies have experienced. There's government support packages that have been introduced both from the pandemic, but also to offset these higher energy prices that are beginning to feed through into the economy. The borders of Japan, which were closed for 2.5 years, were reopened in October. So there's a benefit there from inbound demand. And I'd also add that global semiconductor shortages has had an impact on some fairly major sectors, manufacturing sectors in Japan, that are poised for a pickup next year. So we feel that the growth next year domestically is well underpinned. And as a result, I think some of the opportunities we've seen recently are those that might benefit from that.
Okay, that probably leads me on to sort of a couple other portfolio-related sort of questions. I guess, what is the typical holding period for a stock in the portfolio? And sort of related to that, I guess, what's the turnover been recently?
Okay, so the average turnover since inception is below 20%, so that implies a holding period of 5 years on average. There are a number of holdings in the portfolio that we've held since inception, so maybe now towards 10 years. There are others that may have obviously had sort of a brief appearance in the portfolio, but it really when we buy a stock, identify an opportunity, it's one that we do expect to hold and benefit from compounding. The reasons for selling a stock, I suppose, are the same as same reasons as for buying a stock, really, but it's really to do with the fundamentals. And if we were to feel there's a change in fundamental outlook, either in business context or in terms of the shareholder return profile, and that would be a reason for selling. The other reason is based on valuation. It's a strategy that has a very, very strict sort of valuation discipline based around the attraction of the shareholder return. And if companies move beyond what we consider to be appropriate, then we do either reduce the position or sell it entirely.
Yeah. Okay. Got another sort of portfolio related question here. What is the active share?
The active share currently is 80%.
Right, so nice and high.
Yes.
And another sort of question, how are your companies reacting to the weak yen? I mean, presumably this sort of makes, if they're exporters, makes them more competitive, but also I guess if you're importing raw materials, that's an issue as well.
Yes, I mean it's been a challenge for the nation as a whole. I think the weak yen, but again, sort of companies have become well adept at sort of managing variables like that. Most companies really seek a stability of the exchange rates rather than any particular level. That allows them to sort of manage their business on a more pragmatic basis. They're able to hedge any sort of currency risks. And one thing that has been evident over the last 15-20 years is that more and more companies have looked to eliminate as much currency risk overall by matching regional sales or local sales with local assets or local procurement. So on average, I think if you look at Japan as a whole, it does benefit from weak yen in terms of reported earnings. If you look at it from an individual company standpoint, it can be quite different. But the majority of companies that that we look at, I think, sort of look to eliminate most of the risks internally.
Okay. Somebody's been reading your fact sheets. It says you mentioned the prospect of a labour shortage in Japan in the recent fact sheet. What challenges will this present?
Yeah, I mean, this is one of the very interesting dynamics in Japan. There has been a labour shortage or signs of a labour shortage for quite a period as the population ages. The working population, I think, has been declining since '95. So this has created shortages in some areas that have been addressed with the female population. So the female labour participation rate amongst females has risen quite dramatically in Japan. Also, and this I think may be relevant certainly in the near term, there is a very clear evidence of older generations remaining in the workforce. So reaching retirement age of 60 and beyond, and actually remaining in the workforce in a way that hasn't been the case before. Prior to the pandemic, a very, very interesting topic was the attitudes towards immigration in Japan and an increase in the number of foreign workers in Japan. Obviously, that came to a grinding halt because of the restrictions on the international borders of Japan, and it'll be interesting to see whether or not that picks up again. But we're very aware of the fact, and companies themselves are very aware of the fact that potential for labour shortage, and are being quite innovative, I think, in the ways that they are thinking of approaching this. Looking at sort of labour saving initiatives, use of AI where appropriate, considering alternative job practices from those that have existed in before. So labour mobility, for example, I think is something that we will see continue to rise in Japan. Historically, there has been a sort of job for life mentality in many companies. That is beginning to change, and the whole employment structure in Japan, I think, is ripe for change going forward, and that creates very, very interesting opportunities.
Interesting. I mean, I understand robotics is sort of quite a big thing in Japan. Do you see this sort of playing a part?
Yeah, I do. Yeah, many companies in Japan have sort of reduced their reliance on labour through technology. We've seen, and Japan has some very well, has leading companies in areas like robotics, companies like Fanuc or Yaskawa, which are well known. Those are international companies that sort of have benefited in the past from global investment in that area. But I think one area where we are seeing significant investment actually now is in digitalization. You could argue that Japan's been quite slow in embracing this. So the use of AI is an important topic with a lot of companies actually at the moment. And I think investment in software, IT is a very interesting opportunity going forward.
Yeah, I think we've probably partly answered this question, but perhaps there's a little bit more to add. It says, what are your current thoughts on technology stocks in Japan? And is this a potential growth area for the company?
Yeah, I mean, there are different areas within tech. We've tended to avoid consumer goods companies because Japan has lost, or if you go back to 15, 20 years, has lost a lot of competitiveness in those areas. But actually, if you sort of break apart a lot of consumer electronics, you'll see that the main components and the value-added components are Japanese. And that's an area where we have exposure. Companies like Kyocera and Murata are leading manufacturers of high-frequency components such as capacitors. That's an area that we like. If other companies, companies like Shinetsu, global leading manufacturer of silicon wafer, amongst other things. So it tends to be more materials and components rather than headline products. But Japan does retain leadership in those areas, and those are obviously very interesting areas to invest.
Okay. Somebody's asked, do you own shares in the trust?
Me, yes, I do, yes.
Excellent. We always like to see that. What gearing does the company have, and what is its structure?
Okay, we have a structural geared position of 20%. That is something that was determined by the board when we launched, with our input as well. And the reasons for the structural position are, in the short term, it boosts the income generating capacity, which is something we feel is very attractive and differentiates us in the sector. But also, if we look at it from a longer term perspective, and say from an investment standpoint, we take a long term view, then even going back to sort of 1989 to now, or certainly when we launched a few years ago, there were quite a number of companies in Japan whose share price had actually risen in yen terms. So even though the market had famously sort of fallen very, very significantly, there were individual companies whose share prices had gone up. And if we looked at the characteristics of those companies, many of those, first and foremost, had good businesses. So that's important. But also we're able to sort of complement that growth with a consistently rising shareholder return. So we felt, or do feel, that in the long run, there is a benefit as well if we can identify companies with those characteristics from having the structural gearing position of 20%, because you'll see a capital appreciation as well.
Okay, excellent. Good question here. What is your exposure to Japanese banks, and what are your thoughts on this sector moving forward?
Yeah, we have exposure to Japanese banks, but I'll make it very clear that the ones that we own are the mega banks, not the regional banking sector in Japan. With still negative interest rates in Japan, the operating environment for traditional banking businesses is still very, very tough, and arguably loss-making. If you look at the large mega banks over the last 15 years, they've transformed themselves quite dramatically. Whereas they used to be traditional lenders in Japan, they take deposits from individuals in Japan and lend them to Japanese corporates, which, as I mentioned, is a very tough business at the moment. They become financial holding companies with many different lines of business: leasing, asset management, securities, etc. These are areas that are very different, and there are significant opportunities. Asset management, obviously, being one that's very, very clear, given the aging population and the historical preference for holding cash over investments. So, we think that those businesses are very much more stable. and have seen that. And the stability of that cash flow has allowed them to generate the sort of profile that we want. They have very strong balance sheets, certainly in comparison to a lot of the Western banks. And when we first invested in the Japanese banks, actually in 2016, we looked worldwide because we were what we were seeing from Japanese banks was that the strong balance sheets and the growth opportunities were allowing them to generate a shareholder return that was considerably better than they had been able to generate previously. So, and when we looked globally at 2016, there were only 2 banks worldwide that were paying dividends higher than they were in 2008. That was JP Morgan and Wells Fargo. But actually, Japanese banks, the 3 leading Japanese banks, Japanese mega banks, were doing that as well, and they have continued to grow those dividends quite substantially in the intervening years, and also buy back shares. The prospects, I think, going forward are quite encouraging. That's even before we consider an end to the very restricted monetary policy, the very loose monetary policy that exists in Japan. So if interest rates were to rise in Japan, and that's not our central sort of standpoint at this point in time, the profitability of the banks would improve quite dramatically. So a combination really of the attractive profile of shareholder returns and the growth opportunities that we see means that we see a lot of interest in Japanese banks at the moment. But just to make it very clear, it's really the mega banks, not the regional banking sector.
Yeah. You were just sort of saying about the potential for sort of rising interest rates. We've got a question here that's, I guess, slightly related to that, so maybe it's worth addressing. It just says, are you optimistic of the dollar weakening stroke yen strengthening, and what effect will this have on companies stroke the portfolio?
Yeah, certainly 2 or 3 weeks ago, it was very clear that the yen had weakened beyond, I think, what anyone had previously expected, and what the Japanese government or Ministry of Finance deemed to be appropriate or even relevant. So there was an intervention in the currency market, and the yen has strengthened. That's coincided with dollar weakness, and that has sort of been favourable for Japanese equities over the short term. Our view is actually that the opportunity might still be for further strength in the yen. If we look at prospects for monetary policy in Japan, there is a very interesting point coming very soon with the retirement of Bank of Japan Governor Kuroda. He's been the architect of this very easy monetary policy in Japan, and has been steadfast and very stubborn in his view. But he will retire in early April this year, and we don't yet know who the new governor will be, but they will sit down on day one with a very, very different environment to Kuroda when he first took the job, and with the prospects, and we are seeing signs of inflation in Japan for the first time in many years. Then there is the possibility that monetary policy in Japan could change, and that would be very, very positive, I think, for some areas in the economy. Banking sector probably being the most obvious.
Excellent. Okay, we're coming up to the hour, so I think there's a few more questions, but we'll have to leave it there. But thank you for sort of giving us really good overview of the strategy and sort of talking to us on the trust. And hopefully we'll be able to get you back in another sort of year's time or so, and you can sort of give us an update on how it's going.
Right.
But there's a great summary of sort of how it's going thus far.
Thank you.
Sort of very quickly, before I sort of tie this up, 16th of December, that's obviously today. Not sure what's happening there, apologies for that. So I think this is the last show of this year, because we don't think that anybody really want to tune in next week just before Christmas Eve. But we're back on the 6th of January with James and Andrew McHattie. They're going to give their 2022 roundup of the year. And then on the 13th of January, we've got manager of Vietnam Enterprise. And then I think we're sort of getting somebody lined up for the next 2 dates, but we've then got Eileen Fargus of Ecofin US Renewables. So thanks everybody for tuning in, and we will see you in January. Thanks very much.